All right, welcome, Dan. Good to see you.
Well, thank you. Nice to see you as well.
So, Dan, we got to talk about this Chiefs a few weeks ago, and we got to know you through Libra and our friend Gonzalo. Now, I've been told you've got a pretty good story about how you met your wife in a DC bar with Gonzalo.
So that's funny. It wasn't a DC bar, it was a New York City bar.
Okay.
So the story is and it's a true story. Gonzalo, myself, and a bunch of other colleagues were coming out of a prudential meeting in downtown Manhattan, and it was a Monday, and it was a 2 or 3 day meeting, and I was sick of eating the rubber chicken after the meeting. So a few of us headed out to find our own little way in New York City for a nice gentlemanly dinner. And we stroll in. One of the gentlemen had to go use the bathroom. So we strolled into a restaurant, and sitting at the restaurant was this blonde hair. That's all I saw. There's one person sitting at the bar. So I went over to the bar and I ordered myself a drink and the other gentleman a drink. And when the gentleman came out of the bathroom, the way it was positioned, and I had zero interaction with Beth at the time, she was facing, away from me on her phone. And the gentleman comes out of the bathroom and he saw me in such a way when I went to go grab my drink and I ordered him one as well. Beth, who was looking that way, naturally turned her head thinking that I was in her space. We caught eyes. And it was that 15 seconds stare, literally, where there nothing was said. And I just looked at her and I said, "Oh, I apologize. I'm staring at you." I said, "Wow." And she kept looking at me. And I said, "Well, I apologize. You're most likely married with kids." She kept looking at me and she said, "Well, no, I'm not." And I said, "Oh my God, my name is Dan Anderson and I'm in trouble." So that was it. And literally, her birthday is May 1st, April 30th, the day before her birthday, 6, 7 years ago, I proposed to her at that exact same restaurant bar seat in a surprise. So it's pretty cool. So
That's
that's
very
my story and I'm sticking to it.
good. And happy birthday to her.
Oh, thank you. Thank you very much.
And happy anniversary of proposing.
Yes, exactly right. And it's funny, we were out for her birthday dinner, not only on her birthday, but the day before, April 30th, the day I proposed to her. And I reminded her, I said, "Happy anniversary on proposal." And she was floored that I actually remembered.
How
So it
could
was
you
a nice little
forget?
touch. Yeah,
You got to line up the dates so it's easy.
exactly. And for me, it's a little difficult being as selfish as I am, but it worked out well.
Good. Well, you knew Gonzalo through the GA space, correct?
It's funny, I've got a long history with Gonzalo. My first organization was Insurance Exchange, and I sold that to BICIS, which is now Crump, in 2001. And Gonzalo's organization sold a few years prior. So he and I had the opportunity to work together as colleagues for 3.5 years, which is kind of really neat and magical. And I think the world of Gonzalo Garcia.
Wonderful. And you've started another GA since then and then sold that as well. Talk to me about your
Yes,
space in the life insurance distribution time.
great. So literally spent 35 years in wholesale distribution. My first organization was Insurance Exchange that I just mentioned, and I was fortunate enough to sell that to BICIS or Crump in 2001. And I ran national sales on behalf of BICIS and was very involved in the strategic acquisitions. Did that for a couple of years, for 3.5 years to be exact. We were a publicly traded organization at the time, and I was mid 30s. I was working harder than I ever worked in my life. I had 30 sales locations around the country. I was on a plane more than I would see my family,
Yeah.
and it kind of got old. So I left, getting the entrepreneurial itch, and I fulfilled my 5 year non-compete. And then in May of 2006, I fired up my second operation, Madison Brokerage. And 13 years later, I've had a couple entities come knocking on my door. In May of 2019, I sold that organization to Acrisure. In typical Dan Anderson, I stayed on for 5 years. Again, that entrepreneurial itch. And lo and behold, I'm now doing something to turbocharge the insurance industry through Cornerstone Financing.
Yeah, so you've taken a different step now into a whole new space of home equity. And I want you to explain this because it's different than anything I've heard of previous to you.
Right. So our demographic or our market are those individuals that are top heavy in home equity and or own their home outright. And just to set the stage, Trent, that market is $35 trillion of existing home equity. And 41% of every home in the US is debt-free. So the opportunity to reposition an asset that improves lifestyles is magical. So we're doing that through fractional residential ownership. We will purchase up to 50% of a homeowner's home, convert those proceeds to cash, and the homeowner has 100% optionality to use those proceeds in any way they choose to help fulfill their retirement, create a legacy, or improve our lifestyle, or buy another home, or whatever. But obviously, me coming out of the insurance distribution space, the leverage of insurance, you write a small check to receive a big check is pretty powerful. And it's the first time ever, and again, this is not a debt instrument. It's the first time ever where the insurance audience is now in alignment with the wealth advisor, where we're not attacking their AUM, and more importantly, we're providing AUM protection in a holistic financial planning opportunity. So it's kind of cool, to take $35 trillion and to bring that type of liquidity to the insurance industry is pretty powerful. Last year, the insurance industry, was $450 billion industry, which means $450 billion came out of AUM, which means $450 billion did not have the opportunity to earn 23 or 24% what the S&P achieved last year.
Right.
So that's a massive cash drain. And to use home equity in a repositioned environment to improve lifestyles again is powerful. So that's why I'm doing what I'm doing today.
And conversely, that 23% that the S&P earned, what did the home market earn? If you just had that equity, how much would your home appreciate by?
So as we all know, the last 5 years, home equity or home appreciation has skyrocketed due to COVID and due to the other dynamics in the marketplace today. But there's a lot of regions today where home prices are now going down and or flat. And yes, there are some regions that are going up. So depending on your location and the type of home you are in, and we've seen home appreciation historically, in the last year go from -2% up to 10 or 11%. And again, it's highly based on the region and the geography. But historical home appreciation is mid 4%. So we were all taught to pay off our home, which is a smart idea, obviously, up until CHEIFS came along, Cornerstone's product. But now you can still have your home, live in it, enjoy all the home benefits, sell a percentage of your home, use those proceeds, as I said earlier, to improve lifestyles, whether it's investment, buy insurance, buy another home, fund a 529 college planning, or debt consolidation. I mean, it goes on and on and on, the applications for CHEIFS.
And so let's circle back to you identifying this as a non-debt instrument. So we've all heard of reverse mortgages, maybe the HELO locks. How does this differentiate itself, and how did you find this opportunity that it seems like no one else has been able to identify?
Well, there's a couple questions there, and I'll answer them in order. First of all, this is not a reverse mortgage. So a reverse mortgage, the longer you're in that structure, you eventually don't have any existing equity. We cap our fractional ownership at no greater than 50%. So we prefer to be less than 50% and or a minority owner in that home. So we share on the upside appreciation of the home at the time of repayment or the time that the home is sold, or they can refinance this out of the transaction. And more importantly, we also share on the downside. So if we take down a 25% interest in $1 million home today, and in 10 years that $1 million home sells for $500,000, we receive our percentage of $500,000 without any recourse on those proceeds that we initially produced for the seller. So that's that. What was the second question? Oh, how did we? So my partner, Craig Horn, is a structured finance professional, has a long history in the mortgage business, understands fulfillment, execution, capital markets. I've known Craig for 30 plus years. We would historically get together on an annual basis to compare notes, compare ideas. He presented a proprietary annuity home equity funding opportunity. And I said, Craig, it's going to take forever to get number one, carrier approval, two, regulatory, and number three, somebody can copy that in 4 seconds.
Yeah.
So I understood what he was trying to do, using home equity in a non-debt environment to reposition it. And I said, are you familiar with the traditional premium finance industry? And Craig was not. So I educated him on historical traditional premium finance, which has risk. It's a debt instrument.
Right.
I said, wouldn't it be cool if we could use home equity proceeds in a non-debt environment in lieu of premium finance, in lieu of draining down cash or liquidating AUM to provide the protection that the consumers desire? And he said, we have something. So we spent a handful of months, proof of concept, and met with insurance carriers, regulators, private equity, reinsurers, attorneys, you name the audience, distribution. And through that series of monthly meetings, we came up with a product that is hands down the most efficient home equity extraction device in the marketplace. So fractional ownership is not new. It's been in the marketplace for a handful of years. We have just created a instrument that and an opportunity that presents the highest consumer value. And when Craig and I went down this path, we had one commitment to ourselves. If we're going to do something, we're going to make sure it presents the consumer value proposition that does not exist in the marketplace today. So we literally connected a handful of businesses today that have been in existence for a handful of years prior in a highly efficient manner and filed a patent. And that patent is protecting utilization of home equity for insurance-related constructs.
And this seemed to take off overnight then with interest. You had all these meetings, but now we're looking at, am I correct with this number, $285 million in funding that you got to launch this?
Yes. So again, and that's due to Craig's expertise, number one. Two, the validity of what we're doing. The two entities or the two institutions that are created our warehouse is Nomura Bank, is a large Japanese bank. Also, Aquiline was a private equity firm based out of New York City that's founded by the Greenberg family. So those two institutions provided a $285 million revolver. And more importantly, not only do they provide the revolver, both those institutions have the opportunity to own 10% of Cornerstone Financing, which is really powerful.
And so what did the due diligence process look like to flesh out this patent that you came up with?
So the patent process was a series of interactions with the patent attorney where we applied for a business process patent.
Okay.
It's still pending, and ironically, I've got a call at 2 p.m. Eastern Standard Time today to get an update from the patent attorney, which we believe is going to be favorable. But to be determined if we receive that patent, but I
Right.
think we're going to get it. My spidey senses are telling me with 90% certainty we're going to receive that patent.
Good. And how about with the due diligence from your funders?
So again, Craig has a long history. Craig
Yeah.
Horn has a long history in that space, and more importantly, credibility. So by resurrecting former relationships and former warehouse lenders and bringing a very unique construct and opportunity, that process was not that difficult in getting institutions lined up to create that $285 million line. And candidly, we've had a number of additional institutions coming to us to increase it and participate, to take 285 up to 500 and or a billion. So when you start throwing around those kind of numbers, literally, we could fund $285 million of insurance policies every month.
Yeah.
And what we do is we securitize these securities in the back end, and once they're securitized, the institutions reload the warehouse, and we keep going. So it's pretty fascinating model.
Yeah, it's incredible.
Yes.
So you're looking at a, a 285 million in backing, likely to grow. You're looking at a patent pending proprietary business model, and
Yeah.
we're looking at a home equity market that is hungry for a new way to do things, and a insurance market that's at butting heads with other financial services. And you've created something here that sits in this really beautiful place
It's
in the middle of it.
Yes, it's kind of magical. So for the first time ever, the AUM audience is reaching out to their insurance professional and saying, "Hey, that protection you talked about for a long period of time, we talked about liquidating funds and the consequences of liquidating funds in a highly appreciated market, where to liquidate $100,000, it may cost that client $160,000. Well, I heard about Chiefs. There's an opportunity to, harvest home equity, reposition it to provide better outcomes for consumers. It's ultimate alignment. And again, this is not it's not just an origination product, it's also an extremely powerful in-force funding opportunity as well.
Yeah. And so talk to me about what that process looks like. Let's say I owned a home outright. What would I be going through in this process, and what would I get at the back end of it?
So great question. So we're in the referral business. So we are aligning ourselves with advisors. Advisors make our product available to the consumer. The consumer reaches out to our success team. That's what we call our sales test, the
Okay.
success team. Reach out to our success team and we walk them through the process. And the process is really simple. It's an application. There's no financial underwriting. The only underwriting we do is equity underwriting. So there's no
Mm.
financial provided. So if you own your home outright, you're a great candidate for Cornerstone and/or Chiefs. Once the applications is completed and reviewed, we do two-step process. The first process or step is to get a commercial appraisal. After
Okay.
the appraisal is done, and typically that takes a handful of days after that appraisal is done, and we agree on the extraction amount or the participation that Cornerstone will take in your home, we go do title work. And title work is 24 to 36 hours. After that process is completed and done, we fund. So we're funding transactions today in 2 weeks. And again, the long pole in the tent what's preventing us from funding is that appraisal. If that appraisal
Mm.
is done today at 4 o'clock, we receive those results tomorrow at 4 o'clock. We
Mhm.
could literally fund by Friday, assuming our title work gets done within 24 hours. It's that fast and furious.
Awesome. And so the reason you're not doing any uh underwriting for financials and just on equity is because there is no repayment, just
Correct.
upside at the sale.
Right. Again, the consumer, the seller is always in control. So
Okay.
they could repay at any time. They could refinance this out of a transaction at any time,
Mm.
or when they sell their home are repaid, or
Right.
obviously through death, we're
Right.
repaid.
And
And there's
so
no expiration on our transact, meaning there's no 30-year note, there's no 10-year. As long as you're in your home, the Chiefs exists. So again, that lines up really well with insurance policies,
right.
which are
And
lifetime policies.
that is something I want to touch on in a second here because you've now got your funding and you recommend putting it into an insurance product, whether that be
Well, let
a
me let me let me
yeah,
again, the advisor and the consumer are the quarterback here. We
right.
don't recommend, we're providing a highly efficient funding opportunity.
Mm.
And the advisor is the quarterback in the transaction. We don't have any say in how those proceeds are used. Again, candidly, if an advisor drops a big chunk of proceeds in a survivorship policy and that home is sold 13 years later, that policy still exists. There's no
Right.
connectivity, which is really magical.
That is. And in essence, they could use this money to get a depreciating asset like a car. They could use this money to put down payments for their children's home.
Yes,
But we've looked at some really interesting models of using this as a way for life insurance. And having those not connected is, you're right, is a beautiful thing.
it really
Uh,
is. It's also really powerful for these hybrid long-term care policies that have a
yeah,
large death benefit backdrop. I mean, so that death benefit, that tax-free death benefit, more than satisfies the chief's payoff. So
right.
it's kind of like we're making it really difficult for consumers to pay cash
Mm.
versus liquidating a percentage of their home. And I'll say that again. When you buy these insurance products, you liquidate a percentage of your investment portfolio. It's no different than liquidating a percentage of your home equity. Pretty
Except
neat.
that the assets under management might perform better than the home. So this would be
It's
better
funny you
return.
say that. I mean, the S&P historical in the last 75 years is 11.5%,
Yeah,
compared to home appreciation at 4. Home appreciation, owning 100% of your home, I'm going to say this again, owning 100% of your home does not improve your lifestyle. If you own 50% of your home and you enjoyed all the benefits of home ownership and you could free up proceeds to improve your lifestyle, that's a game changer, my friend.
yeah. And so let's go back to that hybrid long-term care product. We looked at John Hancock, and there were some pretty incredible multiples of how much you were increasing that equity.
Right. So it's funny you say that John Hancock product is called Life Care. And that
Mhm.
was introduced in the marketplace about 6 weeks ago. When
Yeah,
that product came out, my partner and I had chills. It's almost like that product was designed for Chiefs funding. And what's unique about that product are three things. One, the death benefit increases every year. Two, the LTC benefit increases each year. And three, the cash surrender value increases each year. So we've run a couple analytics on, and it looks like the increase in death benefit and in LTC coverage is about 4% per year increase. Well, isn't that kind of magical? That's
yeah,
historically what home appreciation's done, 4%. But more importantly, you didn't pay for that contract until you sell your home.
right.
So you get the benefit of transferring home equity to our cash instrument where we fund that policy, where we give the client the proceeds to buy that policy. It's an amazing IRR
Yeah.
without liquidating AUM.
I know that product, unfortunately, not available in California yet, but you participate in the Vitality, which we're big believers in, and now that 4% is now much larger multiples.
Yes, really powerful.
And
But again,
now,
we have not seen, I mean, it's not like we picked on Jan Hancock or Jan Hancock, has
right,
candidly all life insurance
yeah,
levered contracts work with Chiefs funding. They all
I
do.
I have on our list that we looked at was Nationwide with their long-term care benefit on just a standard life chassis and Allianz's annuity here that you used, and we saw huge multiples on what that equity turned into.
Yeah, so what's neat about any indexed annuity with these guaranteed lifetime triggers, the roll up, prior to hitting the guaranteed lifetime income trigger, the roll up is a lot more powerful than home appreciation. And
Yeah,
more importantly, you didn't write the check. So
right.
we've modeled out, that Allianz ABC annuity for a 45-year-old. They drop in $100,000 and they sell, literally a small percentage of their home. And that $100,000 guaranteed lifetime income at age 75 is like $260,000 of guaranteed lifetime income. And that $100,000, again, I'm going from memory, that $100,000 at 3% home appreciation, if the client were to choose to pay us off in that 30th year, is like $438,000. So obviously, if you've got 260,000 of guaranteed lifetime income, you could get a mortgage at roughly $3,000 a month if you choose to buy us out of the transaction in that 30th year, and you still have $170,000 or $180,000 of
Right.
guaranteed income, and you own your home 100%. So these are the type of instruments and structures that candidly distribution has brought to us. It's
Yeah.
not like Dan Anderson is sitting behind a computer here and figuring out, find the needle in the haystack. Distribution has come to us and said, hey, this is how we're going to use Chiefs funding. Take a look at this. And it's been an aha moment.
Which, Dan, I'm going to just address the audience now. We're happy to look at these because the numbers, and we're happy to send these out. This will be in the marketing information that we send out with this video. We'll have links to it. You got to look at these numbers, and it's really carrier agnostic of how
Yes.
the benefits are coming out. Some carriers, of course, are going to do better. Some products are going to do better. But when you're looking at the strategies that are available to you, it's really the whole toolbox of an insurance agent, not just this only works in this small sector. It's really amazing.
It is. It's the first time ever where, there's, two ways to pay for insurance policies today
Yeah,
prior to Chiefs. It's cash AUM or traditional premium finance.
right.
Now, as I said earlier, it's no different than liquidating a percentage of your portfolio versus liquidating a percentage of your home.
Yeah. And so we talk about this home ownership and paying off in 30 years. That's just a, a proxy for how much we are getting out of this contract. But I do want to talk about the costs associated with it, because if going back to the example of me owning my home outright, uh, does this make sense for me if I'm looking to move within the next 5 years?
Fantastic question. So the answer is no. If you're looking to move out of your home in the next 5 years, there are more efficient
Hmm.
debt instruments that exist in the marketplace. Obviously, a HELOC, a home equity line of credit. CHEIFS, our product, really stacks up well for longer duration individuals that stay in their home. And my definition of longer duration is 10 years and plus. So if you desire to stay in your home, and again, it could be on your second home, it could be on your third home. We prefer and desire owner-occupied homes. So it's not rental, it's not commercial, it's not VRBO. But again, those individuals that have a desire to stay in their home for a duration greater than 10 years, there is no more efficient funding opportunity than Chiefs in the
Hmm.
marketplace today.
And the piece that I got excited about with that statement of staying in long term, and a few advisors that we work with have gotten excited about, is the idea that somebody near retirement who hasn't done the planning for long-term care or estate planning, and has put that off. Cost of insurance is high. They probably can't pay for it out of pocket. And they just want to be done with it. And they want to have that money set aside for long-term care if they were to need it. And I think of my grandfather who's in memory care now. And had we planned this type of thing 30 years ago, it would have been great. Um, but that's just an exciting opportunity that now those people who say I would like to have planned, but I didn't, and now it costs too much, they have this massive amount of home equity that they're sitting on that they can repurpose towards this.
No question. It's funny you said that. We're finding the second generation, the 30, 40-year-olds that are demanding that mom and dad look at Chiefs because they're obviously going to inherit potentially the future healthcare liability. But again, second generation, like myself, we're selfish. We want to make sure that, mom and dad are spending money on this instrument, whether they do a chief, that death benefit protection, as I said earlier, more than satisfies the chief obligation. So
Right.
it's literally you're getting your healthcare benefits, you're getting your death benefit, tax-free benefits. So you're having your cake and eat it too. And
Yeah.
mom and dad didn't pay for it. And we found through a series of, reach outs to customers and consumers that the second generation does not want mom and dad's home. They
Mm,
want mom and dad to age gracefully and have a enjoyed, financially sound retirement. And by utilizing home equity, repositioning it, as I said earlier, a category killer.
right. And there's no bigger, especially in these instances that we're talking about, there's no bigger drain on an asset than a long-term care event.
No question.
And if you can say we're putting a cap on that because we bought, sorry, not bought, we sold equity in our home up to a certain amount. It did not affect us at the time. We've capped the amount that's going to come out of our estate, and we've now leveraged that for multiples in terms of long-term care. And it's a game-changing conversation to have with a person.
It really is. And again, we're on a massive awareness mission now. I
Yeah.
mean, this is so new, it's so cutting edge, it's so innovative, and candidly, the distribution has embraced this, and we're still in the first inning.
Yeah. So talk to me about that next step. Who is your ideal client to get this, and who
Mhm.
are the ideal advisors you want to work
Yeah, the ideal client are obviously individuals that are extremely top heavy in home equity. So that natural demographic is typically 40, 50, 60 and up.
with? Hmm.
So that's the audience. And again, the advisor population is wow. It's your life insurance, it's your annuity, it's your retirement specialist, it's your trust and estate attorney, it's your private home health care, it's your LTC advisor, it's your realtor, it's
Hmm.
your charitable advisor. I mean, it's your RIA. I can go on and on and on. It's your divorce mitigation opportunity. I mean, there's so many applications of Chiefs, so many.
Yeah. I mean, the opportunities are are really
Endless. They're endless. We've actually had a handful of advisors suggest to grandma and grandpa, again, you having a 4-month-old,
yeah.
hopefully Barry's listening, your father. We've had a few grandparents that are funding 529 plans by selling a percentage of their home. And as you know, those 529 plans are ultimate tax-free leverage that are generational.
Right.
So once you run out of beneficiaries, that 529 can be converted to a Roth IRA. So
Right.
please share this with Barry. But again, that's another innovative way of advisors using chiefs to improve lifestyles.
Right.
It may be for themselves or for the second generation and or their grandchildren.
Yeah. And I know you also talked as well about getting annuities for younger generations and seeing the multiples that grow there. And that's just more clever ways of doing this and getting money out of the estate.
Yes, no question. So there's obviously big estate tax opportunities here.
Right.
Those homes that are already in trust,
Mm.
there's a way to lever them, sell a percentage of that home that's in that trust. We issue the proceeds back to the trust.
Mm.
Those proceeds could be used to buy life insurance in that same trust. There's also opportunity to use chiefs that are in, if that home is in trust to, circumvent and or eliminate gift tax.
Right.
Because again, the home is already in the trust. And if the home is not in the trust, there's some opportunity and some strategies to reduce your taxable estate by selling a percentage of your home, taking
Hmm.
those proceeds, putting it on an islet, and buying the coverage. And it's a win-win with zero out of pocket.
Right. It's everything that gets brought up. It's just extremely clever.
Can you
Uh,
tell I'm excited, Trent? Is
huh?
that
Yeah, I am too. And so we've landed where I wanted to land at the end of this interview, but I still have my brain's still going. And so before we close out, and I ask you to tell them where they can find you and how we can connect
Great.
them. Um, you've now been in the market for a little bit, and what are some clever ideas that have been you've been approached with that never crossed your radar when you were developing this?
Well, again, that outside of insurance, and insurance continues to surprise me. I mean, the insurance audience, they're extremely creative.
Mm.
Both the writing agent population and the brokerage distribution, they continue to surprise us, Chiefs Cornerstone, on effectively using our product to fund product, whether it's in force, whether it's life settlement mitigation, another strategy to retain the policy. But again, outside the insurance space, that divorce equalization mitigation is pretty powerful. So the divorce attorney population has come to us and are looking for more information on how to effectively use this product.
Mm.
RIAs, wealth advisors, enormous opportunity. I mentioned earlier, charitable
Yeah.
is a biggie. Realtors are using this. Individuals that are downsizing.
Mm.
If you've got $1 million home and the seniors want to go down to a $500,000 home and they want to preserve a $500,000, well, in that transaction, that $500,000 new purchase home will put in $100,000 on that new purchased home, and the consumer spends 400, and now they preserve $600,000. So that's kind of clever in a downsizing opportunity and in an upsizing opportunity. Trent and his spouse have $1 million. They want to go spend, buy a home.
Mm.
And Mrs. Zimmermann sees a home for $1,250,000, and Trent says, nope, we agreed for 100% cash transaction. Well, there's an organization out there called Cornerstone that'll be your partner at home on a new transaction. We'll put in the 250. So you now enjoy a $1,250,000 home for only posting $1 million. So pretty creative in the real estate space. And individuals that want to buy
Right.
a second home, and we call it a double dip. We'll do a chief on your first home, use those proceeds to buy a second home. We'll also participate in the second home. So now you're diversified. You have two homes, debt free, and you're
Right.
diversified. We like to say, Trent, it's the gift that just keeps on giving.
It is. It's such a
It's
very
again,
way of
it's
doing
the
this.
reposition of a dormant asset class
Right.
where you now have control over it because you don't control your home equity.
No.
You don't, but you certainly can control home equity repositioned.
Right. It's it's a beautiful, clever plan, and I
Well,
love it.
thank you.
So, for the audience, how can they find you?
So Dan Anderson, Anderson, and Chiefs is our product. I'm going to say that again, Chiefs. And Chiefs, the acronym is converting home equity into financial success. And we spell Chiefs the right way, not like our friends in Kansas City. It's CHEIFS.com. So Chiefs.com and or Cornerstone Financing.com. And my cell phone, I'm happy to give it out. Is that appropriate, Trent?
Sure, go ahead.
Yep, 973-477-7557. So we'd love to hear from you. We'd love to help you and your customers um, age in place and enjoy the success of accumulating a ton of home equity in a repositioned environment.
Beautiful. Well, thank you, Dan. This is a great conversation. Uh, if you're interested in this, Dan's giving you his information. Reach out to us as well for opportunities to repurpose this asset into insurance products, and you'll see the multiples.
Yeah,
Of
so I failed to give you my email address. It's danderson@chiefs.com, CHEIFS.com. danderson@chiefs.com. Thank you.
Of course, thank you.
Say hi to mom and dad. Appreciate you so
I,
much, Trent.
I will.
All right, brother. See you.
See ya.